Hi everyone and welcome to Rock Report. Here we host commodity experts and company CEOs to give our audience a good foundation in their research and due diligence. Before I announce my guest, please take 5 seconds of your time and subscribe to our channel, like our content. It will mean a lot to us. And today's guest is the CEO of Barton Gold Holdings, Mr. Alexander Scanlon. Alexander, you're for the first time on this channel. Thank you for joining us.
No, thank you for having me, Lucian.
My pleasure. Let's start with you. As a founder of Barton Gold, what inspired you to establish the company, and how your background in financial economics and mining advisory influenced that direction?
Well, in many ways, you sort of planted the answer inside the question. My background is fundamentally as an economist. For the past 20 years or so, I have focused on sort of global macroeconomic investment. So a combination of global macro thesis with structured finance. I've worked in mining for the past 15 years, essentially exclusively mining and mining adjacent businesses. And about 10 years ago now, I was doing the same analysis around global credit and inflation risks, global monetary policy risks, the same type of analyses and reaching the same conclusions that I was reaching in 2007 and 2008. Now, before 2007 and 2008, I had been a very long investor in real estate. So I helped build essentially a real estate investment model, trading real estate investment trusts in the US securities markets. This was obviously a very attractive proposition in a rising credit wave. But during that time in 2007, 2008, we could see corporate consumer sovereign credit at record high levels. We could see inflationary features of this giant credit bubble starting to creep through. We started to see overpricing in real estate assets. And then we also started to see these things called subprime mortgages and mortgage-backed securities, the things that have now been essentially made famous by the movie The Big Short.
Yeah.
I actually was short home builders in 2007 and 2008 and did very well out of that. So if we fast forward 9 years later, I found myself looking at a very, very similar situation where I said, we're living in a giant credit bubble where the quality of credit is actually worse than it was before 2007 and 8, but there's more of it. The inflationary features of the market are worse because there's more money. Monetary policy is loose because Western politicians, for the first time in 2009, discovered they could print $1 trillion worth of money and get away with it. Yeah. And if you remember the GFC, when they said, we're going to bail out the big banks, and they said it's going to be a $700 billion bailout, people were outraged. And they printed the money, and then they kept printing the money, and everybody started focusing on the fact that their home value printing. And so keep printing they did. And basically between that time in 2015 or 16, the monetary supply more than doubled. So basically I said, look, I think that we're in a circumstance where we need to be looking for defensive, inflation defensive assets. We're investors in metals and mining. Gold is naturally one of these things. And then we had two particular events during 2016, which really drove us to focus as an investment team on gold. And that was the Brexit vote and the election of Donald Trump. Now, these are two topics that are very emotional topics for people, right? Yeah. But we can set aside our political viewpoints and however we feel about, right side versus left side politics, and just sort of read the event, right? What happened in those events? What happened in those events was the two leading Western liberal democracies, who were the chief proponents of the post-World War II NATO-led order, and who are the chief beneficiaries of globalization, saying, we've had enough. We're tired of sort of reaching out we're going to pull back, we're going to focus inward. Now those were signals of very profound changes to come. And I think a lot of people didn't read those completely. I think a lot of people thought that the moment or the signal would pass, but those two events represented the most active voting blocs in these two countries saying, enough's enough, we don't like globalization, it's time to turn inward. And anytime you have a perpetually expanding superpower or the dominant superpower contract, you create space for conflict. When you say we are going to break military and trade alliances, you create space for conflict and additional transactional costs. And if you're creating transactional costs, you're creating inflation. So we said, okay, inflation is clearly now going to be amplified. It's going to accelerate. And we're also going to have greater geopolitical contest. In the world of competition to control commodities, money, and monetary decisions and all of these things, we also saw and thought that gold would essentially serve a greater monetary role then. And that's gold's role in the monetary system has been compressed and declined for the past 50 years. Fast forward to today, and in a way, I'm sorry to say that everything that I thought would happen has happened. And there have been two events that have really accelerated all of this. And one was the advent of COVID, when Western politicians said, forget this $1 trillion a year stuff, let's print $20 trillion. And the other thing, of course, was the conflict between Russia and Ukraine. But more importantly, the United States' response to that by effectively, for the first time in history, weaponizing US Treasuries, saying, Russia, we disagree with you, and there were good reasons to disagree, but saying, Russia, we are essentially freezing your treasuries, which means US Treasuries are no longer a reserve asset, which means everybody who either doesn't want to be under the control of the US or doesn't want to stand so close to the US anymore is going to start holding other assets. And that was that was the moment in which gold broke from its relationship with the US dollar and its relationship with US interest rates. So that's a very long answer to the question, but I think it's important because it's fundamental to the question of why we did what we did, but also why we're saying what we're saying and where the world is going to be in another 10 years.
Yeah, very good overview. And I agree with every word you said over here. That's the reason why you have Barton Gold Holdings, your company that you founded. Can you provide us an overview of the company, the mission, how it positioned itself within the Australian gold exploration and production industry?
Yeah, look, in a very short summary, we are a pure play gold. So this is a pure gold vehicle focused on the state of South Australia. And the reason we focused on South Australia was that it is a very, very rich geological domain. It's very well known globally. It is the host of BHP Billiton's Olympic Dam project. And to the south and to the north, the Carapatina and Prominent Hill project. So this is very well known. South Australia is the largest copper producer and the largest uranium producer in Australia. So it's sort of the Chile and the Kazakhstan of Australia. What was curious, though, is that while South Australia has a 130-year history of high-grade gold production, when the gold price collapsed in the late 1990s, and everybody was very focused on copper investment, what happened was that all of the investment focus went to copper. And when the gold price came back in the late 2000s, everybody went back to the places they really remembered the most, which was Queensland and Western Australia. And they essentially left South Australia uncompeted. And we saw the opportunity to effectively consolidate every significant historical exploration and production asset in the Central Gawler Craton, and we bought the only gold mill. So we essentially saw an opportunity to consolidate a region. So we put that together in a strange way of saying, this is a 130-year-old gold district, but we sort of have first mover advantage again. We're resetting the district. We have all of the processing infrastructure. We have access to road. We have access to rail. So the idea was to essentially corner the market and actually build a much larger platform, which we've now done over the last 5 years. and then go back and use our existing mill to start stage one operations and self-fund and grow from there. So we've now mapped out a pathway to 150,000 ounces per annum of production, not by spending $400 million upfront, but by spending about $20 million upfront to start operations and then grow.
That's very good. Like you said, you have the unique asset in owning the only regional gold mill in the central Gawler Craton. Uh, if you can expand a bit on the mill, let's say if I want to build a new mill over there today, what's the cost of building this kind of facility, and how strategic is owning this kind of facility?
So there are fundamentally two costs, right? First is the financial cost, and the other is the time. So we have to remember that, in a jurisdiction like Australia, we have, for good reasons, we have very, very rigorous environmental protection and planning and development applications laws. If you wanted to build that mill where it is today, starting from scratch, right, you would have to go through a 2 to 3 year process of getting the approvals to build, to get the mining lease, to build the mill, to operate the mill. You would have to get your environmental permits to do it. You would have to secure your Environmental Protection Agency license. And you would probably spend between $200 to $300 million in the course of doing that, including the construction of the mill. So in a manner of speaking, when we think about how strategic is that, compared to anybody else who might have resources that they wish to process, we are sort of 2 to 3 years and $200 to $300 million ahead of anyone else who might wish to transition from pre-production to production. And of course, the tangential benefit is we hold that control in our hands. We don't have to get approval from anyone else, and we also don't have to use anyone else's mill, which means we can catch the economics from both sides of the combination of mill and asset.
You have two flagship projects that include sorry if I said it, Turkila, right?
So Tonkilia we have Tarcoola and
Turkula.
Tonkilia.
Yeah, my apologies.
Two,
Could you
no, we have some unusual names in Australia. Yeah.
Yeah, especially for me as a European, sometimes. Yeah, never mind. Could you highlight the current status and the potential of the Tankila Gold project, especially after the recent, if I remember correctly, 20% boost in the contained gold over there, right?
Correct. Yeah. So Tonkilia is that large scale stage 2 asset. So this was where we said, hey, we bought a mill. We could turn it on 5 years ago. And we said, no, let's exercise the discipline to keep the mill on care and maintenance, do a lot of work, build up a much larger platform, and create a destination of much greater consequence, both in terms of the scale of operations, but the value of those operations. So we didn't want to aim for 50,000 ounces per annum. We wanted to aim for 150,000 ounces per annum. And the Tonkilia project was really central to that strategy. So this is an asset we acquired in 2020. It was a 550,000 ounce asset. We have since grown it to 1.6 million ounces, including the latest upgrade, which you mentioned, which added about 120,000 ounces. The way that that project works and what made it so attractive is that it's very broad, continuous mineralization along the western margin of a shear zone. So it's very broad, very bulk mineralization. It's about 80 to 100 meters wide, the mineralization. So it's a European football field long, wide. So we can use very large equipment. We can have very low unit operating costs and therefore make high unit margins. The very attractive component of this project is that in the middle of the main deposit, which is 3 kilometers long, there's actually a higher grade central zone. And it's about 300 meters long, so 10% of the length of the deposit. The effect of this is that in what we call our stage 1 starter pit, we have not a profile, the average profile of the project, but we have an elevated grade profile. So the project in total will be producing just around 1 million ounces of gold from that pit. So about 120,000 ounces of gold per annum. There's a silver credit as well, about 250,000 ounces of silver, but in value, relatively quite small. What's interesting is over this 8-year project, we generate about $2.7 billion in operating free cash, but 50% of that, nearly 50% of that, arrives in the first 2.5 years. And that's because of these higher grade zones in the middle. So we have our stage 1 and our stage 2 pit shells. The stage 1 pit shell, if we compare that with the average annual operating model, the average annual operating model is processing 5 million tons of material at a 0.7 gram head grade, so big bulk head grade, to produce 120,000 ounces of gold. But the starter pit, the first stage, is processing about 6 million tons during a period of 13 months at a grade of 1.2 grams. And that means you're producing 206,000 ounces in the first 13 months. So we generate over $800 million in operating free cash pretty much in the first year, and we pay back the whole development twice over in 1 year. The second stage of the pit adds another 165,000 ounces in the next year. So in the first 2.5 years, we actually generate $1.3 billion in operating free cash, which can pay for the project 3 times over. So it's an extraordinarily strong financial profile, and it creates this not only a large-scale production anchor, but a large-scale financial anchor that our financial partners are very attracted to. And it means now that we turn on stage 1, this is sort of a low-cost, low-risk stepladder to get to stage 2. And our financial partners are very happy to come and make sure we're fully funded in credit because we have a balanced operating profile with 2 operations next door.
Yeah, those are some great numbers over here. Let's stick with numbers. What about production costs, operating costs, all-in sustaining costs? Can you give me some color on that?
So the average cash operating cost per ounce is about 2,100 Australian dollars per ounce, which is around 1,450 US dollars, 1,400 to 1,450 US dollars per ounce, depending upon the exchange rate. That's the life of mine. That's the life of mine cash cost. The all-in sustaining cost adds about $50 to that. It's not too much more. So it's around 2,200 Australian or about 1,450 US. That's the average. In the starter pit, the first 200,000 ounces are actually produced at a cash cost of 997 Australian dollars per ounce or 650 US dollars per ounce. So we have a margin of about 4,000 Australian dollars or close to 3,000 US dollars per ounce. And then the first 2 pits combined, the margin is about $3,500 per ounce. So that is, or I should say the cash cost then is 1,500 Australian or right around 1,000 US. So for the first 2.5 years of operations, Tunkillia will be one of the lowest cost gold producers in the world, which is why it has this very attractive payback period. It generates a 73% internal rate of return before using any leverage.
Understood. The exploration upside on your projects, especially on Tarcoola, any key exploration targets you have over there? What is the plan on the exploration front?
So at Tunkillia itself, we have that 1.6 million ounces and actually a relatively short area on our project. We have a very large project, piece of property there. Those 1.6 million ounces sit within about 5 or 6 kilometers. We have another 20 kilometers of strike along the shear zone that we will now explore for and see if we can turn that into 3, 4, 5 million ounces. See if we can find more of those deposits. But thinking again, reflecting upon the sort of the theory of marginally higher grade. So these first 2 stages of operation at Tunkillia, where you have slightly higher grade and much, much lower costs, that illustrates sort of the economic horsepower and the economies of scale in that mill. So you would love to have some more high-grade gold nearby, and that's where we go back up to that Tarcoola project, which is right next door, just to the north. And that is actually the home of high-grade gold in South Australia. So this is where gold was discovered in 1893, the same year as Western Australia. And back then, people were mining it by hand. The grades near surface were 30, 40, and 50 grams per ton in high-grade veins. And 100 years later, a small open pit was dug that produced about 35,000 ounces. And that was processed using our mill. So we own that mine. We have that existing open pit. Now we have about 20,000 ounces of gold at a higher grade there, about 2 grams per ton. We can grow that resource some more around the pit. And that pit presents an opportunity to send higher grade ore down to Tunkillia and blend there, but also to go through our existing mill for our stage one operations. That pit was producing high grade ore to our mill during 2017 and 2018. So we have a fully permitted mine, a fully permitted mill, proven metallurgy, proven logistics, proven infrastructure. So it's a low risk startup. But then the question becomes, well, what else is around that existing open pit? And what we've gone and done while building Tunkillia to scale is to actually build a new model for Tarcoola. When we bought that asset in the end of 2019, early 2020, we were the first people to do any work on that exploration license in over 20 years. So that was very, very interesting to us. And what we did is we built a new geological model that identified over a dozen structures that were parallel and sort of cross-cutting the same structure, which created that high-grade open pit. And some of these were very deep tapping structures. So they go all the way down into the intrusives that created the gold mineralization there. In one target in particular, Tolmer, we drilled several targets and found gold everywhere. But one target in particular was very attractive, and that was called Tolmer. So we drilled that last year, and in August of 2024, we announced a new high-grade gold discovery. And then we drilled it and we extended it. And then we were doing some geochemical testing because you can use not only geological structure, but geochemical structure to predict continuity and use for exploration. Now, this is an historical gold field, very high-grade gold. And so one would not be surprised to find high-grade gold in a high-grade gold field. Historically, however, the amount of silver that you would find with the gold is quite small. You might find 1 ounce of silver for every 6 ounces of gold. We did the geochemical testing on that silver and found out that we had silver up to 300 grams per ton associated with gold up to 80 grams per ton. So much, much higher grade silver than we were expecting. And then we went about 500 meters to the west and we drilled a single line of drill holes on another target. And that identified a very, very high grade silver discovery. So something that was sort of globally recognized 6 weeks ago. We identified there not another gold with silver, but a very high grade silver with some high grade gold. We have 7 holes in one line. The first holes we published included a drilling intersection of 6 meters at 4,747 grams per ton silver. And that was within 50 meters of surface. And that was the fourth highest, I think that was the fourth highest silver intersection published on the ASX, the TSX, and the London Stock Exchange in the first quarter of 2025.
Nice.
3 weeks later, we published more drill holes that had more 3, 4, 5, and 6,000 gram meter intersections. So everyone is now very excited about this. We have a very strong gold discovery. We have a very strong silver discovery. Interestingly, the highest grade silver there also has high grade gold, 3 grams per ton gold. So the question for us now is, what is this? We have only 2 dimensions of understanding. We have width, we have height, but we only have 1 line, so we don't have any depth. So we have actually mobilized a new drilling program that will start drilling next week. It's only been 6 weeks since we discovered this. We're going to drill another 2,500 meters there to continue drilling to the west where this is getting thicker and go north and south and see if we can put a 3rd dimension on this and essentially define a high-grade bulk open pitable silver deposit. And the real question is actually, this is silver sitting in the oxide and transitional zone. Is this telling us that there's something much bigger in the fresh rock below? So Tolmer has turned into a very exciting thing that can in the future feed both stage 1 and high-grade blending to our second mill.
Yeah, when it comes to the infrastructure, you said you have it all over there, but what do you need to build in the upcoming period for the development of the project? What do you need to build more roads, or tell me more?
So for the initial stage 1, we actually don't need to build anything. So we have existing roads, we have existing mine camps, we have an existing mill, we have existing supporting infrastructure, we have existing bore fields for our process water. We also have the largest private airstrip in central South Australia. So it's large enough to land a Hercules aircraft.
And it's
So
operational.
it's actually a dirt airfield that we use a roller to keep compacted. So it's fully operational. What we are going to do, the one thing that we need to do is decide how we want to reconfigure our mill because we're going to do now, we've been talking about Tonkilia an awful lot for the past 3 years. Now we're saying, look, Tonkilia is clearly going to be a large-scale operation of value. It's now moving into the standard mining lease application environmental process. And now we're coming back over to talk about stage one. So we're going to be identifying what materials are going to go through that mill. We're going to be identifying over the next 3 to 4 months how we're going to reconfigure that plant to process these materials, what it's going to cost, and then how much we're going to produce. And because we're essentially reconfiguring an existing plant, which is in decent condition, it's not going to take a lot to restart that. So what we're really looking at is achieving the output of a $500 million investment at Tonkilia by starting with a $10 to $20 million investment here and then generating cash and self-funding this development and expansion.
Got it. How is your company leveraging technology to reduce costs and accelerate development? And what specific innovations are you implementing in your exploration and processing operations?
So the answer is a lot and many. We actually started our exploration thesis as a research and development project. So the opportunity being Central South Australia was that it was underexplored. And therefore, in some sense, the land was left in the 1990s, and we had to quickly bring it into the 2020s. So we actually invest a lot in research and development. We actually have developed some of our own proprietary techniques. We are actually building our own proprietary equipment and even chip scanning software right now to allow us to basically capture and analyze data faster than we could, even if we went to a laboratory providing this service. So we're building new technologies, but we're also actually working with other technologies that haven't been used in these settings. And we've been testing a lot of them to see, can we create a new tool set for exploration undercover in this region and accelerate development and discovery? And the answer has been yes, we've been very successful at that. And this is one reason we've been really efficient. So we think very hard and we invest in this sort of new technology and building models, and then we aim very carefully. The consequence or the result is that we have a very high hit rate, a very high percentage of successful drilling. Typically, if you're doing broad scale exploration and drilling a lot of holes, you might have a 5% success rate on your drill holes in terms of finding structure or gold if you're successful. We have a hit rate closer to 75%. And so we think carefully, we actually aim deep and then work our way back to shallow as opposed to starting shallow and going deep. We've also, through this, been the beneficiary of more than $5 million in state and federal grant funding. So we've worked with the state and federal governments to trial applications of existing and new technologies on our ground. And we've even gone so far as to actually work with, you may be familiar with Ineos Automotive. They have created the new Grenadier vehicle. We were actually their mine site trial partner in Australia when they were doing the global trials of this vehicle. So we got to play with the engineering prototypes over all of our ground.
That's great. Yeah, I heard of them. That's definitely great. Cash balance. You touched on that, and we can expand a bit on that. How do you plan to balance near-term cash generation, such as through gold sales with long-term resource growth and production goals? How is that cash balance looking going forward?
Yeah. So we have about $7 million in cash presently. And of course, because we're a pre-production company, we are still a net cash consumer. However, that said, when we bought this mill and all of these assets, we haven't just let them sit and wait patiently to be used for production. We've actually been extracting value from these assets along the way. So we actually rent our camps and our airfields to other parties operating in the region, both private and government. We have produced and sold gold in small volumes from our mill and some of our small scale stockpiles. Again, we have been the beneficiary of some good grant and tax programs. And we've also disposed of equipment and, village accommodation and equipment that to us have no value, but to somebody else have great value. We in particular saw an opportunity during COVID when global shipping was shut down. Some of our older mine site accommodation became very, very, very valuable. And really, it was actually quite close to us essentially scrapping it and rebuilding it. But it was suddenly worth $1.5 million. So we sold it to somebody who needed it. The net effect is that we have generated internally about $15 million in revenue and about $12 million worth of profits or additional net free cash through these initiatives. And what it means is, we IPO'd 4 years ago. In 4 years, we have only raised 9 million Australian dollars publicly, or about $6 million US dollars.
That's good.
Because we've generated 12 million internally. So we co-fund ourselves internally. And the result is that we've had, during a very difficult period of time for gold equities, not because anyone was negative about gold, but just not interested. We have only raised 6 million US dollars in 4 years, where most of our peers or our compatriots in the market have raised $6 million every 6, 9, or 12 months. And they've done that at deeply discounted placements. So they have significantly diluted their shareholders. Our shareholders today still own the vast, vast majority of the company. In fact, probably 95% of our shares are still held by people who owned them 4 years ago. They've continued to consolidate their holdings instead of be diluted. So we're in a really good position. We have several other things that we continue to monetize. And in terms of what we need going forward, the bridge for us to cross is not so great. We need to spend $10 to $20 million to restart our stage 1 operations. Now, we have to remember this is existing, fully permitted above ground infrastructure. So we can look at using debt. I mean, we could use debt to build one. But now we're talking about a mill that might be worth $100 to $200 million. And we could look at borrowing $10 or $20 million with that mill as security and use much, much less in the way of equity. So we're in a very good position to continue our low dilution strategy. And really what we're trying to do is preserve tomorrow's outcomes, tomorrow's benefits for today's shareholders.
Right. How is your M&A approach looking? Are there any plans to acquire additional assets or expand maybe into other regions?
So right now we like being focused around our 2 asset platforms. I think there are a lot of opportunities, I'll say that, right? We see opportunities all the time. We are very big fans of the principle of focus, right? So if you spread yourself too thin, if you try to do too many things, if you have to divide your time or your money too many ways, you can achieve nothing. And so we have focused very intently on building Tunkillia to a large-scale platform. We are now focused very intently on building our stage 1 platform to go into operations. Once we have these 2 things settled and crystallized, suddenly we now have more time, attention, and with an operating mill, cash flow to look at other opportunities. Now, there are opportunities around us that have found small gold deposits. Now, these are not big enough things to justify building your own mill. It would be very expensive to grow them enough to try to do that. Now, there's some potential that we may work with these parties in the future in terms of providing milling services to these deposits. Some parties we would very gladly work with. Others we definitely will not work with, and we've made publicly clear who that is. And then as we look further afield, as we're generating cash and we're generating value and our shares become more valuable, we have reviewed a number of opportunities, many of which, when we look at them, we think like private equity investors. In reality, we are private equity investors. We're professional investors and asset managers who happen to be operating within the context of a public listed gold company. So we're looking for assets that we think we can do better with than the vendor. And in a lot of cases, the vendor knows better. The vendor can do better. We want to make sure that anything we do buy in the future is immediately accretive in value for our shareholders. So that's the way we kind of look at things. And, we continue to review things. Certainly, M&A is on the cards in the future, but we're going to be very, very selective because, again, we don't want to just dilute our shareholders' interests and buy things for the sake of buying things. And even worse, we don't want to commit the sin of creating a base of value and then diluting that value or creating a strong cash flow that could be returned to shareholders and waste that on ill-advised M&A.
Yeah, makes sense. Makes totally sense. How are you approaching marketing? How are you telling the story? Or can you tell the story much better? Is there any new marketing initiatives going forward?
Look, I think we do a pretty good job. One thing we pride ourselves on is being very transparent and engaged with our investors. So we have actually very carefully built our share register over a long period of time. We we have never done a single retail placement after our IPO. So when we IPO'd, we had about 500 retail shareholders. And today we have somewhere between 2,500 and 3,000 retail shareholders. And this has all been a product of it's a company-led marketing. So we get out and we like to engage with people a lot. We have tried many conferences. We found those that we feel are really high quality to us, but we're really best engaging with people. We stay away from a lot of like sort of digital marketing. We like to know with whom we're connecting because fundamentally we have built a relationship of faith and performance with our shareholders, which is why we see our shareholders consolidating our register instead of escaping our register. In terms of the way that we do things, we balance our investor relations presence and engagement between Australia, Europe, and North America. Again, very intentional model. We have three different, essentially, cultural pools of investor. These are three different types of investors that think very differently, somewhat, very differently in some big ways and very differently in some subtle ways. But what we try to do is balance our time and make sure that we are engaging with investors who fundamentally are long-term investors who are investing in our team and our strategy and long-term value creation instead of short-term news flow. That's really key for us. One of the things that we do, which sets us apart, is we maintain a mailing list. All companies do or should maintain a mailing list. But on a monthly basis, I actually sit down at the end of the month and I write a letter to all of the recipients of the mailing list and say, it's been a big month. It's always a big month. We're always very, very busy. But this is what we've done this month. This is why we think this is significant. This is what it's telling us to go do. And this is what we have coming up. So this is what we're thinking. This is what we're aiming for. This is what you should expect to see. And it's a tool that we've gotten very strong feedback for because we have so many significant announcements that sometimes people just don't have time to read them all. But they can go read one letter from me a month and be more informed about what we're doing and how we're spending your money, right? How we're investing your money than almost any other company in the market. And we get really positive feedback from people who say, look, whether I read your letter or whether I see you once every 6 months, you're the most transparent. I know exactly what's going on all the time. And every time I see you, you have done everything that you said you were going to do, and you've done it faster, better, cheaper, and somehow you have not diluted me. So for us, it's really about that very close connection to our investors, a relationship of faith, and we are very accessible. Anybody who sends us a mail, I will get on the phone and talk to them, whether they have 200 shares or 2 million shares. So we really put in the extra effort to make sure that our investors feel respected as co-owners of the company.
Yeah, kudos to that. Really, that's a great initiative. And personally, I would like to see more CEOs doing that. But unfortunately, I would dare to say 90% of CEOs will not do that. So really, congrats on that. That is the right approach. Alexander, final question. News flow from the company, upcoming catalysts and announcements that shareholders should watch for in the upcoming period, couple of months or something like that.
So the next, as usual, the next 3 to 4 months will be very busy for us. The first most immediate catalyst is we made a very, very high grade silver discovery 6 weeks ago, and we have expedited another major drilling program. So with the drilling, we're also sending our own geochemical team into field to use our portable PPB technology, which allows us to essentially generate based not reportable assays, but assays that we can use within a range of confidence to identify, are we going in the right direction, or is it getting hotter or colder? So we can steer our drilling programs in real time. And this is one of the key technology things that we helped co-develop. So over the next 4 to 6 weeks, we should have a lot of news flow around what we're doing in drilling, initial indications in terms of seeing if we can map this lead and silver halo, and then a series of drilling results coming out. And obviously, if we are finding high-grade silver extensions of that like we have found, I think the market's going to be very excited about that. Secondly, we're going to be upgrading our stage 1 area resources. Those resources that we would look at putting through our mill, we're going to be publishing our studies on how much it's going to cost to reconfigure our mill. And I think people are then going to really realize just how cheap it is for us to be going from a developer to producer status. We're going to be publishing our stage 1 production studies. How much are we going to produce? How much is it going to cost? How much are we going to earn? And then we will basically be publishing our plans for putting this into operations during 2026. And in parallel, Tonkilia, back to stage 2. This is all advancing in parallel. So we've actually just kicked off our environmental scoping. We're going to start our water monitoring, which is the real long lead time item for mining approvals. We're going to start our flora and fauna studies, and we're also going to look at reserve conversion drilling. So we're going to accelerate the most important parts of the drilling to upgrade our resource, to make it convertible to reserve. And a lot of that has to do with essentially increasing the density and confidence around that higher grade zone. It's already at an indicated level of confidence, but some of that will bring to measured, and that will fully essentially underwrite the future credit piece. And it means that we can have some very serious conversations with our tier 1 global banking partners much, much earlier, and put this all together for high-speed development. So it's going to be a very exciting time for us as we move forward.
Yeah, and I wish you luck with all that. That was CEO of Barton Gold, Mr. Alexander Scanlon. Alexander, thank you for joining me today.
Thank you for having me.